Good morning, everyone. This is Marshall Gittler bringing you the morning comment for October 3rd. Well, ECB President Draghi said he would outline the details of the ECB's asset-backed securities buying program at yesterday's meeting, and he did. He didn't go any further, though. He didn't specify how much he intended to buy. He didn't say how he was going to get the bank's balance sheet back up to 2012 levels, and most importantly, he failed to repeat last week's hint that he'd be willing to countenance full-blown quantitative easing and buy sovereign bonds if necessary to achieve that. There were no more comments about the ECB being willing to, quote, alter the size or composition of our unconventional interventions, unquote, if necessary. It could be that Draghi was unable to overcome German objections to the idea. Instead, the ECB will focus on the measures that they've already announced, such as yesterday's Habs purchases or the previously announced targeted long-term refinancing operations, the bank loans that they're making. However, it may be hard for them to achieve the goal of rebuilding the ECB's balance sheet back up to 2012 levels just through such measures. So the question for us is that bullish or bearish for the euro? On the one hand, it's bullish, insofar as the ECB's balance sheet might continue to lag other central banks' balance sheets, which is why Eurodollar rebounded after the press conference yesterday. On the other hand, it's bearish in that it also means the Eurozone economy isn't likely to recover anytime soon, and rates will have to remain at current rock-bottom levels indefinitely, meaning two things. One, there's likely to be an outflow from Eurozone assets. Two, the euro could turn into the funding currency of choice, along with the yen. I think the latter is more likely, and I continue to be bearish the euro. As for today, the big thing, of course, is going to be the U.S. non-farm payrolls figure for September. U.S. jobless claims fell unexpectedly yesterday to a level not seen since 2006, while the number of planned layoffs by U.S. employers fell to a 14-year low in September, and Gallup's job creation index hit a 6-year high. These figures set the stage for a pretty strong employment report today. The consensus forecast is for a rise of 215,000, up from the unexpectedly low 142,000 in August. The unemployment rate's forecast to remain unchanged at 6.1%, while average hourly earnings, actually it's an important figure, are expected to accelerate slightly on a year-on-year basis. Now, data along these lines could be expected to support the dollar, in my view, as they'd confirm the steady improvement in the labor market, which is one of the key worries for the Fed. This could be a surprise for the market. Fed funds rate expectations have actually fallen by nearly 20 basis points over the last 2 weeks, although they're still a bit higher than they were at the time of the last payroll figure. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX Global, wishing you solid trading.